Welcome to the second webinar on current topics for Marist life and mission in the world. This initiative has been organized by the General Administration and the International Commission on Economic Affairs. In this opportunity, Star of the Seas Province and Morgan Stanley Bank are helping us. There are 6 webinar sessions that will take place until August 26. On this occasion, the topic we are going to develop is the management of financial assets. As you know, financial investments are a great responsibility for the leaders of the economy of the administrative units. To help us on this subject, we have Ms. Bernie from Australia. I now turn the floor to Mr. Paul Borges, Bursar of the province of Star of the Sea. He will be in charge of introducing our guests. You have the floor, Paul, and thank you very much.
Thank you, Brother Goyo, and thank you, Brother George and Flavia, for organising this venture. We're very grateful. My task here is simply to introduce our guest speaker, Bernadette, or Bernie Connolly, as I know her. We're very grateful for Bernie sharing this time with us, and we're grateful to you all for taking the opportunity to share in this time. Bernie is an executive director of Morgan Stanley in Australia. She's a person of 30 plus years in the investment community here in Australia. She is very, very highly regarded in that community. Being with Morgan Stanley gives us here in Australia the advantage of global capability, but also local sensitivities. Investing for a not-for-profit, and particularly for a faith-based not-for-profit like the Marist Brothers, involves challenges because we have particular ways or screens that we ask our investment managers to respect in investing our funds, and that adds a further complexity, but also opportunities when looking at how to balance our investment mandates, how to place our investments, how to monitor and manage those investments. Bernie has been helping us with this for more than 12 years here in Australia and recently as part of the Star of the Sea province. So I'd like to welcome Bernie and thank her for joining us. And I'll now hand over to Bernie. And at the end of the session, there'll be an opportunity for questions. And I'm sure Bernie would like me to say that if there's a point on which clarification sooner would help, by all means, raise your hand or try and get our attention, because sometimes it's better to slow the process down, capture that idea before we move on. So Bernie, welcome.
Yeah, so thank you very much for having me. And I would like to really just start by saying that it's a great honour for me to be able to present to you today, but I also want to just be sure to share with you that everything I'm saying here is very general in nature. And not knowing the very specific circumstances around each organisation, I will be speaking more in very general terms. But my hope is really that I'm able to share with you, just in this short time we have together, some of the core principles of investing and a framework that can support you with the prudent management of these very important financial resources of the Marists. So if I may start with an analogy of a garden, I think that investing money with the aim of growing this money into a larger amount is like planting a seed. And just like trying to grow a tree, it will not happen overnight. And there will be risks along the way that will need to be understood and to be managed. And in a garden, there are risks such as the weather conditions or pests. And with investing, there are risks, and there can be many, including companies that are mismanaged or even countries. And also, like a garden, once an investment portfolio has been established, at times we'll need to weed out some assets that may be not performing, and maybe we need to prune some investments that have grown fast or that are crowding out the garden. But a good investment portfolio should grow over time at a healthy rate and ultimately help to provide for the future. But how long will it take to grow an investment? So let's say that you want to double your money. I'm going to show you a shortcut to work this out. And of all the numbers we might see today, the one number to remember is number 72. And in fact, in finance, we call this the rule of 72. So the rule of 72 says that if you want to double your money, for example, in 10 years, you will need a return each year of 7.2%. So that's 72 divided by the number of years to double your investment is the return that you'll need to achieve. Another calculation would be to say, if you get a 7.2% return, it will take you 10 years to double your money. So this is compounding interest. Another way to describe compounding is interest on interest. And Einstein famously called it the eighth wonder of the world. The legendary investor Warren Buffett, that some people may have heard of, he referred to this idea of compounding as the snowball effect. And it tells how his wealth started by letting compounding do its thing, just like a snowball rolling down a hill and getting bigger and bigger. And I want to show you in practice how this concept of compounding has worked over the last 100 years. So what this graph is showing us here are different type of investments that all started with $1 back nearly 100 years ago. The orange line, and please excuse me, these are US numbers where we've got a lot of data, so this is not specific to Australia or to any other country except the US. We see here the inflation rate in that country, and the blue line here, the light blue line, is their 30-day Treasury bill market. That's equivalent to like a cash deposit, a very, very secure cash deposit backed by the US government. So over this very long period of nearly 100 years, that $1 invested in Treasury bills at a rate of 3.3%, that grew to $25. If we look at another example of an asset, the US long-term government bonds, that's in the green line, an investment of $1 in that investment at 5.2% grew to $161. But what is really interesting, if we look at if we're looking just at the numbers up on the top left here, the dark blue line, the S&P 500, that gave us double the return of a government bond. A government bond was 5.2%, and this S&P 500, which is a measure of the stock market, the 500 biggest shares in the US market, that gave an average return of 10.4%, double that of the government bonds. But look what an incredible difference the outcome was at the end of this nearly 100-year period. The 5.2% return gave $161. Not bad, but because of compounding, that is the earnings upon the earnings, that investment returned $18,000. But what I think is even more insightful is that if we look at the difference between the S&P 500, the 500 stocks that gave an average return of 10.4%, and the grey line that gave a return of 11.7%, you might think, well, there's not that much difference, 10.4, 11.7, it's all about the same. That small difference over a long period made a significant difference. That the small caps would have been valued at $60,000. So it's true that a little bit of difference in a return over a long period of time because of compounding makes a big difference. But before we look any further into investment returns, I wanted to talk about probably the most boring investment of all, which is cash. And cash is also sometimes referred to as liquidity. It has a very important role for an investor. And I think these I won't call them rules, this concept here is relevant to many organisations. Cash is first and foremost the spending money. Before we even think about being an investor, we have to make sure that we have money for our, as an individual, our day-to-day needs. For an organisation, similarly, the day-to-day needs. We also need another bucket of cash, which we call here in this middle one, reserve cash. Every organisation is going to be different, but some organisations will have maybe just 6 months of reserves of cash to protect them against some unanticipated event. Some organisations like to have 3 years or more. Everyone's going to be different in how much cash they have. But once the spending money is taken care of, that the reserve cash is taken care of, maybe there is money then to invest. And I will now talk about the importance of cash, whilst you've got cash in any of these buckets, earning a certain return, and that is because of inflation. So inflation eats away the value of a dollar. So whenever we have money, at the very least, we would like it to give us a return equal to, or ideally greater than, inflation. And inflation rates are different all around the world, and interest rates are different all around the world. But this idea that investing should be to maintain or grow the value of assets above the rate of inflation is a concept that should hold across many different countries and different interest rate and inflation environments. So if earning a return above inflation is a starting point, I want to talk to you about the idea of asset allocation and asset classes. So you're probably familiar, or maybe you're familiar with an English expression where we say, don't put all your eggs in one basket. Asset allocation is really that when it comes to the investment world. And what I'm showing here are 4 different asset classes. Cash, as we've just had a look at, is an asset class. It is highly liquid and your capital is preserved. The 2 other main asset classes that are usually considered in investment markets, one is fixed income. That's also known in different terminology as a bond market. And that's effectively where an investor is lending money to another organisation or a company or a country with the expectation that they'll get their money back, and in the meantime, they'll get some interest paid. The next asset class is equities. They're also known as shares, and that's when you own a piece of a company. And you own that company for good or for bad. You can share in their fortunes and you can lose everything if that company fails. There is a 4th asset class in the universe that we're looking at here around investments, and we call them alternatives. And they're assets that behave a little bit differently to bonds and a little bit differently to equities. They can have some of those same characteristics, but when we're talking about equities, we're talking about companies that would be listed on the stock markets. Companies like Apple for example, or Nvidia, or some of these better known companies, or Coca-Cola, for example. Whereas an alternative investment might be a private company that's not listed on the stock market, or it might be something like an airport or a group of ships or royalties, music royalties. There's lots of assets that come under this umbrella of alternatives, but pretty much they're just not fixed income and they're not equities necessarily that you'd typically have access to. There's something a little bit different, but importantly have a lower correlation to those assets. They don't behave in terms of their price movements the same as those other assets. When we mix these assets together, what we're doing is asset allocation. And this picture here shows you from the left-hand side to the right-hand side a spectrum of what we might call risk appetites. A conservative investor will want their wealth preserved. They won't want to take too many risks, whereas an aggressive investor might want to take a lot more risks with the idea that they will get a lot more return. And there is a relationship between risk and return. A lower risk asset will typically have a lower expected return, and a higher risk asset will have a higher expected return. But by higher risk, I'd like to show you what this actually means. So this is an example here of 5 different portfolios, and I'm showing you here 4 different time frames. The 4 quadrants here are the 1-year returns in the top left, 3-year, then 5-year, and in the bottom right, 10-year returns. And we're looking at 5 different types of portfolios. And what we can see here, and I might just let us focus on the bottom right-hand side, which is where the 10-year returns are. We can see that the conservative portfolio, on average, over this long period, and I should say this is over around a 25-year period, a conservative portfolio that we constructed earned 6.8%. And if you took more risk, you would have got more return. And for the most aggressive portfolio here that we call a growth portfolio, you would have got 8.4%. Now, again, we might think, oh, well, there's not much of a difference, 6.8, 8.4. If we go back to what we saw previously about the impact of compounding, that can be a very, very different outcome at the end of it. And that small difference in yield over time does make a big difference. But what I'm wanting to point out here is one way that we can describe risk. And I've highlighted there with the green arrow the 1-year return numbers for this risky portfolio. So over a 1-year period, this risky portfolio, on average, it gave 10.2%. That was the 1-year return if we looked at those years individually. But what we can see is risk is that if you were lucky or smart, you may have got a return in one of those years of over 30%. But in a bad year, it could have been you could have lost nearly a third of your money. So what this is telling us is that over a shorter period of time, investments in the riskier portfolios can be some very wide variations. But over a longer period, the difference between the good years and the bad years tend to narrow. And I'm just going to now show you another way of describing this. Here is an example of the returns from a portfolio that only had shares. We'd consider that a risky portfolio. Over a long period of 30 years, the average return of this portfolio here was 9.3%. And the variation, the worst return over that 30-year period, of the 30-year rolling return was 6.5%, and the best 12.7%. But over a 1-year period, it could be extremely volatile. For that reason, we're always mindful that risk can be mitigated, it can be lessened by having a much longer time period and also not having, as I used the expression previously, all your eggs in one basket, and in this case, a risky basket being equities. We do focus a lot in the investment world on the idea of asset allocation. And asset allocation is what we saw before. It's how much do you put into each of those buckets? And the research actually says that the success of one strategy or another is mostly because of asset allocation. It's not because you picked the best share. It's not because you got the timing right. It was actually getting that asset allocation strategy right in the first place. So if you were to say, was I a successful investor in what I was wanting to do, or was I unsuccessful? Most of your success is going to come from having the right asset allocation. And I'll speak a little bit later on how you can work out what is the right asset allocation for you. But when we put together an investment portfolio, we always start with asset allocation. That is the starting point. Putting the portfolio together are the second, third, and fourth steps. Mixing together the right managers, selecting the right managers, and combining the weightings correctly. That's my job, and that is the job of any investment advisor. But the starting point should always be asset allocation. Now, each investor is different, and working out asset allocation is a good first step. So what I'm showing you here is what we call in our industry an efficient frontier. And what this is saying is, firstly, I'll explain to you that on the bottom axis, just going along there from left to right, from 4% to 14%, is a measure of risk. And what we saw before with the equity markets, where there were huge highs and huge lows, that is an example of something that is high risk. Mathematically, we say how much around the average was this wild ride. So that would be a high level of risk, and a low level of risk is here on the left-hand side of that axis. And then the return going from 3% up to 9% is showing us here the relationship. I should say, sorry, this visual here is showing us that relationship between risk and return. Wouldn't it be wonderful if everything could be up in that top left-hand corner? We had a great investment giving us a fantastic return and hardly any risk. Unfortunately, that doesn't really exist. I think if anyone is offering someone an investment like that, it's too good to be true, and it probably is not true. On the other hand, what we would never want is an investment where we're taking a lot of risk. We never want to be down in that far right-hand corner where we're taking a lot of risk and we're not going to get much reward. What this line is telling us here is that there is no right or wrong point along this line. It's just saying this is the appropriate return, or this is the expected return for the amount of risk that you're taking. So many investors would say, for example, I don't want to take too much risk. I know I need to take some, and they might end up with an expected return somewhere between, say, 5% and 7%. That is a realistic type of return over the long term. There might be some years where it's fantastic and we get more than 10%. There may be years where we get something a little bit less than zero. Hopefully not too much less. But overall, that middle ground of risk-taking, you should expect to get something between around that 5 to 7% return. There are ways, and in the interest of time, I won't delve into this, but there are ways that we can shift this curve upwards so that we can get a better return for the same level of risk, and that's by adding additional asset classes, including the asset class of alternative assets that I spoke about earlier. But I'd really like to get into an important point about how do you choose the right investments? What are the things that any investment advisor, like me and the team that I work with, what do we look for before a cent of Marist money goes into an investment? Well, we study these investments. We do a lot of due diligence. We don't pick my favourite share of the day. We don't pick our favourite person that we think is really good at investing. What we look at are fund managers, which include something called ETFs, which are exchange-traded funds. They're just managed funds, but they happen to be bought and sold on a stock market. And we vet them for a number of qualities. We want to be sure that the people who are managing the important resources have a stable business, the right people, the right processes, that they manage the portfolio and their risk well, and that the product that they're offering us to invest is appropriate in terms of many things, including fees. So there's a lot of work that should be done before a cent of money goes into any investment. I touched briefly there on this jargon called an ETF, and there's a lot of talk about ETFs. You may have read about them. I just thought for clarity, I might explain very briefly that a managed fund is something that you may be familiar with, where you give your money to a manager, they invest it in a range of assets, it goes into a pool, and you own part of that pool. An exchange-traded fund isn't too different. You own a pool of assets, and they can be bought and sold on a stock market, but typically the pool of assets reflects something like the S&P 500 or an index that represents a particular group of assets. I think now, for the last part of this session, I really want to speak about the most interesting area of investing, and that's the emotional journey that investors have. And we know that investment markets can go in cycles. Some of you may remember that we had in the year 2000, there was a collapse in the investment markets after what we called the dot-com boom. That collapse came after people were in a euphoric stage about the internet. Prices had gone really high. It was the maximum point of risk when everyone was most excited and most happy with their investments. Typically what happens is the emotional roller coaster of an investor is that at the time when the markets are weak, when everything is looking bleak, let's think to the time after the global financial crisis in 2008, or even just at the onset of COVID, when the markets and the investment markets were really worried about what was going on. Emotionally, it was scary, but it was also the maximum opportunity in the investment markets. I actually think, and this is not personal advice, I think we may be seeing that at the moment with some assets. I know that in the city that I live in, there was a queue outside a gold bullion dealership earlier this week, people lining up to buy gold when, I might add, it had doubled in price. So the maximum point of risk when markets are arguably very expensive is often when people are the most excited about them. Managing our emotions as an investor is a very important part of the job, and it's actually an important part of an investment advisor's job. But how can we manage our investments? Well, I think the most important way is by having an investment plan, an investment strategy. I'm going to just point out here a few things that one should be aware of when investing. So the first point is, and I think we looked at this with some of those wild swings that we can have in investment markets, that in the short term, an investment portfolio can be very volatile. So never invest short-term money in a long-term investment portfolio. Cash is very important. And there's a wonderful expression that's often used, and it says cash is king. So I think that's something that we should always remember, to never invest cash assets that are important perhaps for your day-to-day needs, that you might need to have there for maybe 1 year, 2 years, 3 years or more of expenses. It's only once cash is adequate that one should ever consider being an investor. So tied up with that is knowing your time horizon. There are some investors who might have a 5-year time horizon for their investments. That's actually not a long period of time. That would lend to a very conservative investment portfolio. But an investor who said, actually, I've got this money and I'm here for the next 100 years. These are for the next generations to come. Then a much more aggressive portfolio might be appropriate, as long as everyone who's responsible for this, all the stakeholders, understand that and they're on the same page. I've got a picture there of a train wreck because an important part of investing is diversifying. We never want one event or one company or one incident to derail a long-term investment strategy. So that's really pulling together some of these ideas that I spoke about previously, about knowing that you have enough cash and never investing too much into an investment portfolio, knowing your time horizon, because that will determine the amount of risk you should or shouldn't take, and then the basic concepts around diversification. For an organisation, and this can be different to an individual, they can probably do whatever they want with their own money. If they might not be wise to, but I think when it comes to good governance, and particularly of the Marist important financial resources, I would encourage you to seek advice from a trusted advisor within your networks. Every country is different. There can be even differences between states. So it's really important to understand rules and regulations that might apply to investing any money. In Australia, we have an organisation called the shorthand is the ACNC. It's a little bit like a charities commission that regulates our sector. Possibly in other parts of the world, there may also be regulators, and that might also be a tax office in your countries. The very important thing when I was saying have a plan, the thing that can help you not ride this emotional roller coaster is to have a documented investment policy. What that can do is not only help you focus back on what was our intention, why do we have this money, how did we agree to invest it, but it can also help because we might not all be in the same seats in a couple of years' time. There may be turnover at a trustee level, and a documented investment policy can really help those future trustees understand why the money was there, why the decisions were made. Because what we would really not like to happen is back to the emotional roller coaster at the very worst time in the market when things are looking bad, that perhaps in the future someone looks at the portfolio and says, oh no, there's too much risk here, we're going to sell everything, because it may well be at the bottom of the market. So there are just a few points around good governance. And then finally, I think that the questions that you should ask of an advisor, if you do engage someone, is how they can help you navigate these markets. And they should be able to answer these questions, or you really should be posing these questions. So how am I going to achieve my goals? How should I be invested? Importantly, am I on track? Has what I originally intended, is this represented in these assets that I have? And most importantly, who can I trust to help make decisions? And that will come down to your own networks and the people within your own jurisdictions that you may have relationships with. So they're the end of my formal remarks. I'm just wondering if there are any questions that I might be able to take, or Paul, if there's any comments or observations you'd like to make.
I was just going to make the observation that part of the, one of the most challenging parts is actually to establish a relationship, a partnership, if you like, with somebody who can be trusted to walk with you on this investment journey. I mentioned earlier that we've been working with Bernie and Pat and their team for more than 12 years. We work closely. We receive detailed reports on a monthly basis. We receive presentations on a quarterly basis. They are part of the group that meets with our investment committee to every, say, 3 years or thereabouts. We do a deep review of our investment strategy, and then that gives us the conviction to go forward. Between those deep reviews of the strategy, we might look at tactical adjustments for, it might be geopolitical changes in the world, it might be COVID had massive impacts, it may be significant events. So we keep dynamic insofar as we are able to respond to changes in the environment, but we need to have in the background always that strategy. What is it that when we looked deeply at this, what is it that we decided about what our asset allocation might look like? And that is a function of what risk we're prepared to bear. And the risk that we're prepared to bear in the portfolio is almost a direct consequence of our goals in terms of income or capital growth for that portfolio. So they're all those concepts are tied together, and that's why we have found it so valuable to walk that journey with trusted advisors, trusted experts like Bernie and Pat, and I'm sure that in most of your regions throughout the world, you'd have access to something akin to that, a well-esteemed local investment advisor. Brother Simon.
Yes. Okay. My question is this. Suppose a religious congregation wants to take a loan to invest in a school. What could be some of the key considerations?
I fear that hasn't answered your question, though, Brother Simon. I think what we need to be conscious of is we need to, both at a school level and at a within the province, we need to live within our means. And that is to say that we need to be able to identify at the time that we embark on that build that A, we have enough money to finish building the school, be it through our reserves or be it through borrowing. We make sure that we've got enough to finish the school, to welcome students in. If it's a paying school, are the fees that we are asking for going to be sufficient? Are to enable us to service the loan? Is the financier patient? Is the financier a commercial operation who will demand payment within a certain period of time? Or do they also, are they a mission-based entity like an archdiocese or a diocese, which might be interested in supporting the school with longer terms than you might be able to get from a commercial organisation? So it comes down to a measure of how much you can afford to borrow, and that is a measure of how much income that you can rely on coming in to fund the payments on that loan and to fund the repayment of that loan.
Thank you.
Thanks, Brother Simon. Brother Camille.
Yes, yeah. Good morning to all. In the same line as the previous question, to take a concrete example, for example, to invest for in the schools, but thinking of, let us say, concrete example of school buses. What are the key elements in that investment to be checked and according to what we have listened to investment and the concrete example of school buses in schools? Thank you.
Thanks, Brother Camille. School buses is a good example because it brings in a different concept. If you're investing in the bricks and concrete to build a school, we are hopeful that that structure will remain in place for a significant period of time. If we spend the money on maintaining it, we will have an asset for a long period of time. The school bus is different in that almost from the moment we start using it, it's reducing in value. It's got a firm, useful life. Depending on the condition of the roads, it might have a useful life of 20 years or 30 years, or in some cases, it might have a useful life of 5 or 10 years if the roads are terrible. So we've got to make sure that our investment decision in respect of those buses looks very closely at the useful life of the asset, because it's a terrible, terrible thing to borrow money, for example, on a 10-year or a 15-year plan, but the useful life of the asset is only 5 years. That takes us into an area where we will still be paying something off after it's producing value for us. So you've got to be very, very careful to match the term of the loan with the useful life of the asset.
Yes, thank you very much.
Okay. Emma, can you... oh, yes. Hello, brother.
Yes, good morning.
Good morning.
Good morning, can you hear me?
Yes.
Okay, thank you. So, talking about investments, we operate in a system where we have a lot of uncertainties in terms of economic trend. Giving an example of Nigeria as a case study, the inflation rate keep on rising, things keep on, the naira keeps on weakening before the major currency like dollar. And when you talk about investment, it becomes very difficult, very challenging on which aspect would you invest. When you talk about asset allocation, it becomes very difficult for you where to allocate this assets so that it will take care of inflation. Sometimes you make an investment at the end of the year, you find out that it's really, initially it worth it, but at the end, after 12 months, you find out that it doesn't worth it. So how do we go about this? Thank you.
Whatever you do is protecting your purchasing power in Nigeria. So that may mean if you're investing offshore in Nigeria, you may need to hedge, it's like a kind of insurance against currency movements to ensure that you may not benefit from big devaluations, but equally you won't be penalised if it goes the other way. So most sophisticated investment advisors would be able to guide you. But as Bernie said, it's a very local market and a very, there will be investment advisors who can help you in Nigeria. But that concept of protecting against the devaluation or the rapid inflation of the value of your currency is an interesting one. And that brings into play that hedging, which is a kind of an insurance. Bernie, do you want to speak?
Yeah. I'd add to that exactly, Paul, along those same lines. We have a concept with foreign currency of asset and liability matching. So if you have all your assets are in a particular currency, but all of your business, everything you need to spend that money on is in the same currency, outside of a portfolio where you're just wanting to diversify into shares, ordinarily you would have a bias towards mainly staying in your home currency, unless there's a reason to not. So if all your income's coming in your currency and your outgoings are in that same currency, there has to be a reason for you to not just stick within that currency. For maybe sorry, Paul.
I was just going to make the point. We here in the province in Star of the Sea, it's very tempting to invest some money. The bishops in Papua New Guinea run a fund, and they are currently paying twice the interest rate that is available here in Australia. So it's very tempting to invest heavily in that. But if we take that temptation and if we expose ourselves to that, yes, we might get the higher interest rate, but we do risk a significant devaluation of the Papua New Guinea kina, which could take away all the profits that we've earned. And so, as Bernie was saying, if we're going to spend the money locally, if we're going to support local ministries and the like, then it is always relatively safer to invest locally in local markets that are tied in the same currency as you.
Good morning, everyone. Only for add a little bit, because this question is very interesting. The strategic of the Institute is try to suggest, especially for the stable country, put some part of, if you have a possibility, put some part of the investment outside of the country in currency, strong currency. I think the Innocent try to push this idea because especially when the country is unstable, the valuation is strong. If you have a possibility, because not all country is easy, put the money outside, and the institution have international entities for that. This is one way. Other way is create a more collective investment, because some country is smaller amount of money you have for funding, and this small amount sometimes is risky because you don't have a possibility to negotiate in the market in good way. The suggestion is work more collective, and this helpful in one umbrella in the medium or large term. In this way, I have one question, because the majority country we present here in the webinar is decentralization unities, and included all the school is a little independent. For the, I ask Bernie, for what is the strategic for put more together the money? Because if you invest 1 million, 500,000, 20,000, school by school, or is possible put together, and what is the view for investment, the volume, the recurse you have for investment, and what is the way for try to step by step, not to work isolated?
Yeah, as a general comment, having a larger pool of money will help in terms of getting, firstly, the attention of an advisor who unfortunately would probably not be able to look after very, very small portfolios, but it can also help in terms of a better fee arrangement. But the other side of that is that it would require very, very good governance, a very good understanding of who put in how much, good reporting back to each entity about what their own allocation was to that particular investment pool. So I think there are merits in doing that. The question of currency would come into that as well, because necessarily I imagine some of the entities will be out of their home currency into maybe a currency like the US dollar or euro or what have you. So I think there's merit in it, but I think you would have to be very clear on the governance and the arrangements, and that each entity is very clear on what the foreign currency risks that they are taking, for better or worse. Paul, would you have anything to?
No, that makes sense. You know, Brother George is right. That is a significant advantage of an organisation like the Institute, insofar as we can have a trusted repository offshore that we can trust to hold the funds and to manage the funds. And that's rare to be able to do that in that way. And yes, there are governance requirements, but I think as an institute, we are very conscious of our governance responsibilities, and so I would hope that we could respect those challenges quite well. But that's a good point, Brother George. We do have the ability to place funds offshore in stronger currencies than we might otherwise have access to. There's a question in the chat from Brother Mark. Omedi, the following the principles of savings for the dry days through investment, how do we manage the scarce resources, liquid or so, given the realities of economics and markets? And that is a great question and a fundamental question. It highlights the need to retain in cash sufficient to meet your operating needs for, be it 3 months or 6 months or 12 months, whatever you think is appropriate in the context of your economies and markets. So you've got to make sure that you've got those cash reserves so that you can respond to the challenges that you face in the immediate term. And thereafter, you've got to look at whether, I think I'd take this question, interestingly, back to that frontier, the efficient frontier. If the markets that I have access to would enable me to place things in a position where I'm getting an appropriate return for the risk that I'm taking, then yes, I would encourage involvement in investment markets. But that's what you've got to weigh up. Would placement in the investment markets give me an efficient return, a return that's commensurate with the risk I'm taking on? And if the answer is that I can't reliably ensure that, then I would say that, you need to retain more in cash to deal with the realities that happen day to day.
I would absolutely agree with that, Paul. I'd also say that an investor should also balance this duty that they have to understand what they're invested in and to have the good custody of those assets, but not look at them too often, because it can do your head in. If markets will go up and down, there's always something to worry about. In fact, there's a wonderful expression that says investment markets go up, but they climb the wall of worry. So you want to really avoid being involved in a day-to-day basis, because it really will impact those emotional responses. And that comes back to having the appropriate portfolio and the right amount of risk and the right time frame.
Okay, I would like to ask a question. When we are facing a bad year similar to 2022, where the financial markets are going down, what is your advice, Ms. Bernie, for different brothers? They are managing the financial investments. What is your advice when we are facing the bad moments?
We would advise to make sure you have enough cash so that whenever something like this happens, you don't actually have to sell your portfolio. But what we do is we have what we call strategic asset allocation. And that means, for example, I don't sail boats, but I know people who sail boats. And strategic asset allocation, it would be like saying we're heading north. But in heading north, we might go a little bit northeast or a little bit northwest. We call that tactical asset allocation. So when markets are very weak and we think it's a good buying opportunity, if we have been tactically below what our long-term allocation is, we can adjust and go back up. At the moment, with some particular markets, if they're very, very strong, we might be selling and going a little bit below what our long-term target is. So I think it comes down to having a long-term investment portfolio strategy that all of your stakeholders are aware of. All of the brothers are aware of what this long-term strategy is, but you have a little bit of flexibility around those long-term targets for your asset allocation. That's how the best investment portfolios in the world work, that they've got their strategic asset allocation, but they've got some room to move around that.
I might just add one thing. There's a lot of old sayings that used to be said, never sell at the bottom of the market, never, never, all sorts of old truisms. Now, I think what having a partnership with an organisation, and I won't mention the name, but when you with an investment advisor that you trust, the question is not, shall we sell? We might be at the bottom of the market. What should we do? Should we wait and hold till the market responds a bit more positively? You don't want to be too fixed on that, because every once in a while, I think it's more important to say, well, knowing what we know today, is there a reason, strategic or tactical, to exit a share or a market or a sector? Or is there a good reason to hold? Do we still view that there is potential in that asset class or in that particular asset? Because I think it's always important for us to make those assessments regardless of whether we're at the top of the market or the bottom of the market, and say, what do we know now about this asset class or that particular asset, and factor that into allow enough in your tactical scope to embrace those sorts of changes in our knowledge. We shouldn't be just bound to something just because we decided it was a good thing 12 months ago. Something might have changed. And if something has changed, we need to factor that into our thinking. I just wanted to make that point because it's something I hear a lot of. Yeah.
Yeah. And I might add to this as well that we could often have a situation where we have a great deal of we believe there is a high probability of something happening. Let's say, for an example, I think there's a really good chance we're going to see the stock market fall by 10%. if I had great conviction in that and I get it right, I've got to be right again, because I've got to know, and I've got to be brave, and I've got to be smart that I get back in again, because that market might just bounce back up before I get a chance to get back in. And they're the risks, I think, when you deviate from your long-term strategy. You might get it right, going off the path, but then you've got to get it right again to get back on the path. So there can be risks in trying to time the market and actively trade it. And that's why that coming back to the sound principle of that good investment strategy.
Yeah.
Well, I'm conscious of time at 9:05 here in Dublin. So good morning, everyone. My question really was a rather large one about the whole issue of ethics in investment. And in context, I recently was asked about investments and asked, where do I stand on the topic? And it made me think about it more carefully. Because again, while I might not want to invest in fossil fuels, I still drive cars and I take aeroplanes. So I know it's complicated, but I'm conscious of time. And I don't know if Bernie wants to say anything about this rather large topic for a religious organisation.
I might start off if that's all right, Bernie.
Oh, yes.
And I'll just say that in my opening, I spoke about some of the sensitivities of investing as a Catholic organisation. And that's we add to the complexity in terms of what we ask of Bernie, because we do say that we don't want to have anything to do with tobacco, gambling. We don't want to, we're not puritanical in respect of fossil fuels, because part of fossil fuels, there needs to be a sensible transition away from fossil fuels. But we can't give up on them completely overnight. So we give that layer, if you like, to Bernie. And interestingly, Bernie has mentioned to me previously that many investors, not just Catholic investors who were implored by Pope Francis, Laudato Si, to care for this common home, but many other investors, without those teachings necessarily, are after similar sorts of things. They do not want to invest in gambling. They do not want to invest in tobacco. And so that's an overlay that Bernie is used to and has responded very positively to. Bernie?
Yeah, yes. And I'd say that the industry has responded to that. So there are many investments available which have various labels. Some might be called sustainable investments, but there are also very specific investments that have been vetted for the values of the Catholic Church. So there is, for example, in the US, one can invest in the top US companies, and it's basically a Catholic values investment. And in Europe, there's also a similar Catholic values investment that trades on European stock exchanges. So when it comes to the core equity markets, there are, in fact, many investments, some specifically Catholic, others are just broadly known as sustainable investments. But there are also sustainable fixed income portfolios. So most people think about ethical investment around buying shares. There's equally a place for impact investing or sustainable investing through fixed income. And that's a very powerful part of the market. And in fact, around somewhere between 10 and 15% of all bond issues in the world, and these are trillions of dollars or hundreds of billions of dollars, are in fact issued now as either sustainable or social bonds. And there's a whole other fantastic hour we could spend on this. But I think actually society has moved this way, and it's really encouraging. It's that regardless of what may be happening on the political front in certain countries, there is still this real impulse for sustainable investment and for corporates and investors to use money to direct it to these better investment options.
Thank you.
That was a great question. I wish we had another hour.
We've got a question from Brother Umenze in relation to land acquisition in the chat. And the question is, experience has shown that investing in land acquisition pays in the long run. Given the fact that we are in school apostolate, is it advisable to venture into it now and possibly sell it off in the future when the value appreciates? And we're asked to take that in as Nigeria as a case study. That is a very, very real topic for all of us. If I can talk just briefly about the Australian experience, the brothers did have a great deal of foresight in terms of the purchase of land here in Australia. And they purchased in relatively undeveloped areas because that's where the need was, on the fringes of the cities rather than in the centre of the cities. And so they were able to buy significant tracts of land on the fringes of those cities. And over time, that land became a very substantial and valuable asset, some of which we've realised in recent decades. So I would suggest that, yes, land acquisition does pay off. It gives you, in the more volatile areas, it gives you control. It gives you a control of your destiny in a greater way than, for example, renting a space and building a campus on rented land. And so, yes, if funds are available, the prospect of acquiring land for the building of a school is an attractive option. Even if, it depends if often the educational apostolate calls upon us to educate on the fringes where there is likely to be growth in the coming decades. And so that almost ensures that land purchased will increase in value. Very often, at that point that you are entering into it, there is the prospect of buying surplus land. If you think you need 10 acres or 15 acres on which to put a school, or 8 hectares or 10 hectares on which to establish a school, it may be that the purchase of 12 hectares or 16 hectares or some such, there's not a significant marginal cost to that, but it will provide more in terms of an asset in the longer term. So they are opportunities which might encourage us to be just a little bit more ambitious than we otherwise would. But still, we need to be conscious not to burden ourselves with significant debt at that stage, because acquiring the land is the first step. We've then got to build the school. We've then got to staff the school. And so the purchase of the land can't take up all our resources. We must be able to have access to other resources to fund the things that come after that. Sorry.
I had only remember especially in Africa, you need to be careful because the risk of the land, the invasion. No, if you have assets, you have one cost. This is one point important in Africa, especially in Latin America, and some other country too, is the risk when you have the land. The second one is where coming the money. If the money coming outside in dollar, is be careful, because when you internalize the dollar and buy the land and have a devaluation of the currency again, sometimes you lose money. Some country in Africa recently bought the land, internalized the dollar, bought the land, and 3 years later, the value in dollar is half because the depreciation of the currency. Be careful for that. The third one is focus. If you have a possibility to invest in the school, what you have for making more money in the short term is better than you invest in the land for long term, because you don't have a cash flow. If you don't have a cash flow, it's better you invest in your school running better what you have, generate more money, and in the future you buy the land. Only
Yes.
these three aspects.
No, very, very valid, Brother George, and thank you. Absolutely right. That generation of cash flow is critical. And the point about the currency of internalizing dollars in a volatile currency area is so true. You can be the most prudent steward, but once you let foreign exchange risk into the bargain, you can get in a lot of pain very quickly.
I'd like to say thank you very much, Mr. Paul, Ms. Bernie, for your presentation, for sharing with us your knowledge and suggestions for optimizing our financial access. Thank you very, very much, and may God bless you.
And you're most welcome. Thank you for having me.
Thank
In
you
the
for the
same way,
opportunity.
thank you. In the same way, I thank all of you for your participation, and I invite you for the next webinar that will be on February 26th and 27th. The topic will be addresses will be leadership in the management of the mission in our institutions. For this, we will be accompanied by Mr. Alejandro Cebrián, executive of Edelvives Publishing House in Spain. So, thank you very much. Have a good day, and see you in the next webinar.
Thank you.
Thank you so much.